Welcome to the Real Estate Asset Management Podcast, brought to you by Break of Day Capital. The show focuses on educating syndicators and apartment owners on how to build systems and manage their properties more efficiently to become a best-in-class operator. 100% straight talk. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Asset Management Podcast. I'm your host, Gary Lipsky. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, I have my good friends, Dustin Miles and Hayden Harrington. Welcome, fellas. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah. Hayden, do you want to kind of start off and I'll follow you?
Sure. Yeah. My name's Hayden Harrington, and really appreciate you having us on the podcast, Gary. Based here in Dallas, Texas, been here for about 7-8 years, and originally from the Houston area. One of the managing partners alongside Dustin at Momentum Multifamily, where we focus on acquiring, 100 plus unit apartment complexes in the major metros across Texas.
Awesome. Yeah. And for a quick intro on me. So I'm on the Forest side, the west side of DFW, and my background's in engineering. And so I was an engineer for long time before going real estate full time, and super excited. We bought a deal earlier in Houston, and looking to grow down there.
Awesome. Well, today we're going to talk about the differences in managing a C class versus a B class versus an A class, as you've had some experience in all three. So, curious, what are some of the pros and cons of the different classes from an asset management standpoint?
Yeah, from an asset management standpoint, I mean, so this is just, I'm just speaking from experience. So the C class deals that, at least I've been a part of have also been smaller. So there's also that variable involved as well. And then the A class deals that we've been involved in have been larger. So anytime you have, the appeal of apartments in general is economies of scale. And with economies of scale, you can, generally, buy things cheaper, hire better people and things like that. And so, it's been, in C class versus A, and during COVID, we did see, quite a difference. We had more delinquency, more bad debt, all that on the C side, and the deals where, it was more, kind of that lower C as opposed to that upper C. We did struggle more so. Is what we saw versus the A class product that we have. There were some people that weren't able to pay and things like that, but for the most part, it was just a lot more stable, a lot more seamless, less peaks and valleys and things like that. So it's kind of the main differences.
All right, nice. And how do you guys measure and track your success of the asset that you're managing?
Hayden, you want to jump on that one?
Yeah, I think one of the big things that we do is we obviously get a pro forma from our management company before we even submit an offer. And that's basically the benchmark that we kind of hold them to. So, internally, what we do is, every month we get financials. And so we're inputting them against our pro forma that we got originally and saying, where are we on an annualized basis? How are we actually looking? Are we high in payroll? Are we, low in marketing? Where are we basically at? So we can track, exactly, how we're doing and what to expect, at the end of the year 1, year 2, or so forth. So that's one of the things that we really hold our management company accountable for, what they put out there. Just because, it's easy to put together a pro forma, but what's the actual reality of that? And so that's really what we want to hold them accountable for and stay on top of. Every week we're meeting with them and going over how leasing's going over where the effective rents are and so forth. So we just want to make sure the trajectory is, where it needs to be, and, everybody's interests are kind of focused and aligned.
Yeah, today's November 9th, we're recording this. And so I saw financials come in for one of our properties and the other one's coming in like any minute now. And so got to go through those 200 plus pages of financials and reports and whatnot. Not necessarily fun, but like you get so much information. So kind of looking forward to it, not looking forward to it.
Really?
So what are some of the big lessons you guys learned regarding asset management that you can share with our listeners that maybe in the last year or so?
I'll give an example, and this is from a few years back. Is just a few that kind of come to mind. So I've had some different experiences. Have owned in a different state and all that, and so there's just different things that kind of come along with that. So on the asset management side, working with a management company that is already in that area is huge. If they're not in that area and they're new to the area and things like that, it's so difficult to get them spun up. And it's not anything against them. It's not anything against what they can do and all that. It's really, really difficult to get spun up. And you don't have, especially if you're new to an area, you don't have other properties that you can pull people from, and you just don't know people. You don't have contacts in the market. You don't have subcontractors. You don't have, flooring and things like that. It could be a little more challenging too. So, that was, had to change management companies on a few assets over the years. And that's been, one big thing. And then just in general, the deals that have done well, if, especially on that C class side, if we can, it's the person in that office, the manager is crucial. I mean, they can, it can go, one way or the other, fairly quickly. And, just really being in close contact with them, making sure that they're letting in, the right people. We've had an instance where they didn't let in the right people, and that cleanup can take a while.
Yeah, absolutely. Hayden, what about you? Any big lessons learned of late?
Yeah, I think really just, going back to even before you get the asset, is just really focusing on good locations, because even, it doesn't really matter where it is in any major city, especially, you're going to deal with issues. You're going to have some tenant issues, some crime issues and stuff like that. And, the focusing on a good area on the front end is going to save you a lot of headaches down the road when you do get to that asset management point. So, I think that's one thing to definitely consider, just because, on the front end, the numbers may look really attractive. But again, what's the reality of that? What's the, risk adjusted return? How does that actually play out? Because it's one thing to have numbers on a spreadsheet. It's another to actually be collecting that rent every single month, paying your bills. And so the area, your tenant base, all of those things play an important role into the success of that opportunity. So, I would definitely encourage people just to really focus on that location and understand what you're getting into, because, especially if you're investing outside of your backyard, it's hard to get to know a location and, a 20-minute tour and driving around the area a little bit. That's pretty tough. So again, going back to Dustin's point, that's why it's so important with working with a good management company that can be your boots on the ground as well, that can give you additional insights from your own due diligence that you do on an area. But that would be my biggest piece of advice, because no matter where you buy, you're dealing with people, you're going to have issues come up. And if you want to minimize your headaches and minimize the problems down the road, definitely focus on that location, where you're buying, understanding what you're getting into on the front end, and then just pairing your underwriting and your numbers with, those expectations.
Nice. So it sounds like, Dustin, you guys have kind of abandoned, C class, and you're focusing on maybe B plus A. And I'm curious your thought process on that.
Yeah, I mean, there's a lot of different reasons and philosophies and things like that. We it's probably a little bit easier to manage. Just a kind of that A class, A minus, just a little easier to manage typically. And, a little, potentially a little more stable, although we've seen some that we're not. So, but, and then, we're always looking at risk. And so, as Hayden pointed out, the area, typically that newer product, typically the areas are, a little higher income and things like that. When there is a recession and things like that, those areas typically won't get hit as hard. And then on just a risk, just from a risk perspective, if you go back and look at, CBRE cap rate surveys and you look at A, B, and C, and so you see this, this delta for A's here, B's out further, then C is out, quite a bit. And so there's from our perspective, well, we were like, well, because I'm selling a C class deal and we're selling it for a low 4 cap and we're buying, 2008 product for, high 3 cap. And it's like, let's, granted those are in 2 different metros, but, so anyways, and then, the deal we bought earlier this year, we bought for a 5 cap. We just got a good deal because we bought during COVID, but, anyways, but yeah, those are kind of, some things I don't know, Hayden, if I missed anything.
Yeah, I mean, that's definitely the primary reason. It's just, if your cap rates are all on top of each other across the board, it just makes a little bit more sense to move up the food chain a little bit and lower your risk, to Dustin's point. And you can get similar returns. That's not to say that B and C, there's not good deals out there. It's just they're harder to find. You're paying a premium for everything right now. And it's just, would you rather pay a premium for a 60s deal or a 2000s deal? And in our minds, the 2000s deal in a good area makes a little bit more sense. That may change in the future, but we just feel at this time in the cycle and in the metros that we're focusing on, it just makes a lot of sense to kind of, we still want a value add component. Don't get me wrong too. It's not like we're buying A+ deals. We're buying, like Dustin said, a mid 2000s deal that's 100% classic. So we still absolutely look for that value add. But it's just a little lighter of a value add. And, we're seeing, a lot of success from that deal that we bought earlier this year. We're already exceeding our pro forma by quite a bit. And we're excited about that. So we want to continue to kind of rinse and repeat. Once you do it once and you get your systems in place, it makes it a little easier again. Going back to the asset management, everybody is aligned. Our contractor understands the scope that we're getting into. That makes the rehab a lot quicker, a lot easier, a lot more efficient. Our regional is actually going to be the same regional because we're buying 20 minutes north of where other property is. That's something to really consider about from an asset management standpoint, because if you got 2 deals all the way across the country, that's going to be a lot tougher to manage. So, in our minds, we just want to, mitigate risk however we can. And, grow intelligently and not just grow to grow.
And one thing I just want to add that Hayden, just touched on it, this whole, I won't say game, but this game is, it's mitigating risk. And so that's, right now we feel that helps mitigate our risk. I mean, we'd love to buy it. We're in DFW. We'd love to buy here, but we have to push, in our minds, from what we've seen, we have to push a lot harder to hit our numbers. And we're like, can we hit those numbers? I don't know. DFW's awesome market, strong market. We love it. But so that's kind of why we're in Houston. We don't have to push as much. And so we, it's just, it's a risk game. It's, we feel like our opportunity for success to our investors, because we want them to win, and then everybody wins, and then it's a rinse and repeat situation. They come back, and so we want them to win, and so we're geared towards this. We think this is our best opportunity to win. So
yeah, absolutely, and I love the proximity I have. I'm purchasing my third property within like a 7-mile radius, and I had a fourth, but we sold, and it just makes it so easy follow up on properties and have the same regional and stuff like that. So yeah, absolutely. So our last question, we ask all of our guests this question: what is your asset management superpower? Start off with Dustin.
Oh, that's a good one. I guess just being able to, I think we're both pretty detail oriented. So I don't know if either of us, or maybe, I don't know, maybe, that's Hayden's superpower. But for me, I think being detail oriented helps and all that. But I think just, we're both, very diplomatic and, team oriented. And so, I think just, we both grew up playing sports, and we just we really just see this as another sport. And so we're used to being on teams. We're used to, hey, this is, I played soccer, and so I played defense. So my role is I got to guard these people, make sure they don't score. And so this is just, another team, and I'm on another position. And so that's kind of, I guess just being able to play well with others and play in that team environment and, kind of create win-win scenarios for everybody, I guess, would be mine. Hopefully, Hayden, I didn't steal your thunder there, but so.
Yeah.
All right, Hayden, go ahead.
When you propose that question, that's exactly what my mind jumped to as well. Working in a team, developing teams, because that's what this is. This is a team sport. And, I think that's one reason why Dustin and I work so well together is, we just, bounce ideas and off each other and see what sticks, and we try stuff out. And, we remove our egos from the equation. We're not here to be right. We're here to do what's best for the business, for each other, and for our investors. And so, that's one thing that we keep such a priority here at Momentum is just, we're in this together. How can we build a more efficient team? And, we extend that not just within Momentum, but also with the vendors we work with. You have contractors, you have designers, you have, countertop flooring suppliers, you have all these different vendors that you have to work with. And, it pays dividends, I think, to invest in people and understand who you're getting in business with, and not just jumping at, the first option or the cheapest option that comes along. And so that's one thing that we really like to do too, is really, get to know who we're working with. We did that with our management company. We probably interviewed about a dozen different management companies, and not just talking to them on the phone either. It's, going and meeting them, going and calling their properties and seeing how they're actually performing and so forth. And I think that, just putting in a little extra legwork and building a solid team with people that you trust, and you have that gut feeling that this is a good fit, really pays dividends down the road. So yeah, I hate to sound cheesy, but I think that would be one of mine as well.
Yeah, no, makes sense. And no, I really appreciate you guys coming on the show and adding a ton of value on asset management. I love your philosophy on managing risk, economies of scale, and that team aspect, which is so important. Please tell our listeners where they can find out more about you guys.
Yeah, just our website's momentummultifamily.com, and love to connect, and if there's something we can help with, would love to help.
Awesome. Well, to all of our listeners out there, thanks for listening. And if you like this episode, please head over to iTunes and Stitcher and subscribe, and review this podcast so we can grow our audience and reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website, breakofdaycapital.com, sign up for our newsletter, and we'll talk to you next week. Good night.